Hello and welcome everyone to today's digital live event, CREtech Talks, the VC Perspective Part 3. My name is Ash Gunzandia, Chief Intelligence Officer here at CREtech and Global Head of Real Estate Tech Intelligence, and I'm excited to be your host today. In a few minutes, we will hear from 4 of the most insightful and active tech investors in real estate tech as they discuss their perspectives on the impact of the pandemic on our industry and the greater venture capital market in real estate tech. While we're waiting for everyone to dial in and get set up, wanted to quickly share with our community a list of events that are coming up at CREtech. On Friday, May 15th, we are hosting a CREtech Talks on the evolving dynamics of e-commerce. On Friday, May 22nd, CREtech Talks, Tech-Enabled Capital Markets. On Friday, May 29th, CREtech Talks, Fully Automated Multifamily. On Tuesday, June 9th, we will be hosting our June virtual demo day where you will hear from the most innovative and advanced real estate technology companies in the world. And on Tuesday, September 15th, we'll be hosting another virtual demo day. Throughout today's conversation, if you, our amazing audience and our community, have any questions, please submit them using the Q&A button located at the bottom of your page. We'd love to hear from you, so please, we definitely implore you to ask questions, use the Q&A feature on the bottom, and start submitting your questions. You can do so now. Additionally, we actually want to hear from you. So we're really interested in kind of hearing your perspectives on which technology you think is going to be the most impactful in 2020. You can share your thoughts by taking our quick poll that we will share the results at the end of today's webinar. I see that we have a large crowd, actually a fairly large crowd already gathering, so let's just kind of get the show on the road here. It's my pleasure to introduce today's panel. Steve Weikal, Head of Industry Relations at MIT Center for Real Estate. Julie Lein, Managing Partner at Urban Innovation Fund. Vic Chawla, Partner at Fifth Wall. Louis Schotsky, Managing Partner at Navitas Capital. Shawn Hill, a Partner at Moderne Ventures. Steve, are you there, my friend?
I am, and we're ready to go.
Awesome. I'm going to stop sharing my screen. The stage is now yours, my friend.
Okay. I appreciate it. Thank you very much, Ash. Always a pleasure to do this. This is session number 3. So we have a lot to talk about from the VC perspective. And but before we begin, I would like to thank Michael Beckerman and the entire CREtech team for providing us this platform to have these insightful conversations with the VCs. And I'll also say welcome to the hundreds of people that are joining us from around the world for the webinar, including our guests. Ash, you introduced our terrific lineup today, but let me just give a little background for context for the conversation. Vic is a partner at Fifth Wall, and for those who don't know, Fifth Wall is the largest venture capital firm in the world focused on global real estate tech, on the global real estate industry. They've got $1 billion of capital under management across 3 funds, nearly 50 companies, that's probably bigger now, Vic, active in retail, residential, multifamily, commercial, all product types in the industry. Julie Lein is with us from Urban Innovation Fund, and the Urban Innovation Fund is a fund that provides seed capital and invests in startups around the livability and the sustainability and economic vitality of cities, including a variety of categories: transportation, energy and water, real estate, GovTech, CivTech, 25 firms in the portfolio, and Julie will share a bit about that, I'm sure. Shawn's here with us from Moderne Ventures. The Moderne Fund is focused on early stage technologies that are innovating in real estate, mortgage, finance, insurance, and home services. So there's this intersection with fintech, and the portfolio has nearly 60 firms. And Louis from Navitas, which is a venture capital firm that has focused on really transformative real estate tech for over a decade. He and his partners are also experienced operators, developers, and owners of real estate themselves, so he brings an insider's perspective. He was prior to that, he was at Equity Residential. They did a $60 million fund last year, and the most recent fund is $100 million. So welcome to all of our panelists. Lots to talk about today. I think I'll start with Louis. Louis, you've been through a couple of these cycles, And I was wondering, and Shawn, you can jump in here too, because I know you've been through a couple of these cycles. Let's put this into context. How does this situation that we're going through now compare to the 01-02 cycle and the 07-08 cycle? And we'll take you off mute there, Louis.
There you go. I would say, you know, that the drivers are obviously very different. You know, those were more bubbles. This is an infectious disease, a virus, and I think like the recoveries will be really different as well. You know, it's not an issue of mispricing in the market. It's more an issue of, you know, a lot of economies are really frozen or stuck in the mud, and there's just there's a lot of uncertainty about not just the recovery path, but I think like the bigger thing driving uncertainty is we don't know how the world will be different when COVID retreats, or when we get a handle on.
Yeah, I think we all know that this is a health crisis that triggered an economic crisis, not an economic crisis, which arguably those are the previous situations. Shawn?
Yeah, well, I was in the middle of the lending and credit crisis on the secondary market side. So I was dead in the center in 2008. And this one's different from a credit perspective. That was much more institutional, right? It sort of came from the top down, and you had these banks and large lenders. This one feels much more Main Street and sort of gig economy and that. So I think this feels a little bit more blue collar. And if you look at the sort of employment numbers or the graphs, it was a gradual, that was a gradual unemployment, where this is overnight in 30 days. So I think that makes a huge difference. One sort of Wall Street, and this is more Main Street, and just the sharpness of the curve feels different. Right. And this one actually, I think our economic recovery will be based on something that we can't control, right? And that is infectious disease, which makes this different, and sort of the fear of the unknown makes this one different than the other one, than the one-time event of sort of 9/11 and in 2001 and 2008. So,
Julie, I'm sure you've had plenty of calls. Do you sense any panic?
You know, I think everyone's trying to figure it out. From a portfolio perspective, I think the important thing is being able to survive and thrive. And everyone knows that times of, economic turbulence, capital is a little bit more constrained. And by a little bit, I mean, it could be a lot more constrained. It's only been 2 months into this. But I think everybody needs to kind of focus on this idea of, doing more with less, having a really good pathway to unit economics and profitability that people can actually swallow, instead of saying that you're going to have another round of, a huge fundraise that may not be happening around the corner. So I think everybody needs to just be a little bit more thoughtful and put, profitability, unit economics, and things that, frankly, at the early stage, we don't tend to talk about as much for startups, front and center, so you can survive and thrive through this.
Yeah, there's been discussion that this forces everybody to come back to basics. No surprise. Have any of you seen any accelerated decision, putting deals on hold, any kind of panicked decision making, or is it still pretty thoughtful and calm out there? I mean,
would say
we've read about a few deals being put on hold.
I would say there was hyper acceleration in the beginning of March until April 1. It felt like I remember, looking at your phone and Tom Hanks and the NBA stopped. I remember where I was. That was like the time, and then there was hyper acceleration for the next 2 weeks. Whether you were fundraising, whether you're doing whatever, like let's get these things done and buttoned up. And then, as April 1, it feels like people pulled back, because reality started to, really started to set in as more and more things we realized just sort of how broad it is. So I would say there's 2 moments, one of acceleration, one of deceleration, pretty quickly.
Yeah, Vic,
sure.
I think Vic, go ahead.
Yeah, sure. I would add that I agree with John's comments. I think it has been bifurcated to some degree. So obviously retail, hospitality, and office, both the physical assets and the corresponding technology companies have been uniquely impacted by COVID-19. On the other hand, a number of businesses, again, both in the physical and technology space, in e-commerce and logistics, have sort of seen some tailwinds because of stay at home. And certain businesses in that space have commanded additional funding on very attractive terms, in fact, because their businesses are seeing a tailwind from people staying at home. So I would definitely agree that the market has changed, particularly for earlier stage companies. But to date, capital has still been flowing into specifically those opportunities that are seeing certain tailwinds because folks are staying home to keep everyone safe. So.
On our pre-call, we had a conversation about the underlying real estate industry versus the tech industry, but I forget, who was it that brought it up? I forget who brought it up. Was it Vic?
Might have been me.
Yeah. So we can come back to that because these are two different businesses. One is the tech business, the other is the real estate business, and they're joined at the hip. But on the operational level, what does open for business mean for a VC? Ash shared the CREtech research indicated that in the last 30 days, roughly $2.5 to $3 billion roughly $2.5 to $3 billion of VC activity. Although we should keep in mind a couple of large slugs were in there, like the Airbnb slug, but nonetheless, there is activity going on. So what does it mean right now to be open for business? All of you can weigh in on this.
Yeah, I'd
Sure.
be happy
So
go ahead.
Okay. So just on the open for business comment, look, I think every VC pretty much followed a similar playbook, which was first you to go company by company and triage businesses. For no fault of their own, certain businesses were shut down because of stay-at-home orders in terms of being able to sell their product to their end customers, whether that's businesses in the iBuying space or businesses in the hospitality space. And so, there were really a set of companies that you had to really go through and make sure you understood what is the amount of runway the business currently has and what additional financings may or may not be on the horizon. And then, I think every VC first wanted to do that to protect their existing portfolio. Then the next conversation was pro ratas from in-round processes, so rounds that had already started closing out those pro ratas. And then I think the third stage of that is sort of new active investments. As much as COVID's been in the news, it feels like it's been a year to date from the first stay-at-home orders has been, a little over, really on a national basis, a month and a half. So when you think about that period of time, it's really been about a month and a half that's seen a massive market dislocation. I do believe venture investors will invest through the cycle. It's been shown investing through the cycle is a smart thing to do, but there's steps you have to take to first triage your portfolio before you can sort of keep actively investing. You just only have so much time as a venture investor to spend your day on. So,
Julie, do you want to add to that?
Yeah, I think that was really well said and definitely mirrors our process as well. What I would just add to that is, first, there is quite a bit of dry powder out there in terms of venture capital, deployment and capital that needs to be deployed. And I do think that many people see a downturn as a real opportunity when valuations might not be as crazy. And, we've had so many of our most iconic companies formed during downturns. So, I think that some people, and we are definitely included in that, will see this time as a bit of a renaissance for new startup formation, because you really need to be hungry and tenacious to, build a company during such a turbulent time. The second thing I would add to that is in terms of process, I think a lot of people are moving to, a very different workflow, which is now all of your meetings are being done via Zoom. And I think for us, we had always done quite a bit of meetings with entrepreneurs and deal flow calls through Zoom. But I think it's that idea of meeting somebody through video and taking it all the way through the diligence cycle to ultimately making an investment when you might not have met the person, in real life, and might not have seen, if they have a hardware product, you might not have seen it in real life. And I think that's, just a process-oriented change of pace that, luckily we are very comfortable with at the pre-seed and seed, but I do think that we will need other investors, especially downstream investors, to get comfortable with that as well.
Right.
I had talked to someone just real quick, because I think that's a good point, especially for entrepreneurs out there. I was on the phone with another VC, and he said, "Are you going to invest without meeting someone?" And I said, "Probably, and maybe, and he said, "We won't." And he said, "We will not, as a firm, without meeting someone face to face, do that." And he said, "How would you get comfortable doing that?" And I said, "We're in Chicago, we're not on the coast, and and so we always have, but we're going to depend on the people that know that entrepreneur. I'm going to depend on people that are on the phone, that are co-investors here, as to, to give me some idea who those people are, because they may have met them before. So that open for business is, yes, the process, we are all changing our processes internally, and what we're comfortable with is evolving. And I don't know, some people have a hard and fast line, some people don't, and we'll have to change just like business as well.
We're talking about face-to-face on funding and startups. What about face-to-face? This is a question from one of the attendees about biz dev. Does this impact your expectations about timelines for startups to reach revenue milestones, given that the selling environment is now also quite different? Comments on that, Lou?
I mean, I would say, of course. I think that, there's just been a general slowing of commerce across the board, whether you're talking about commercial deals for real estate tech startups, real estate deals themselves, the leasing activity within different levels of real estate. It is, just across the board slowing. The thing that I would say is that is definitely not a blanket statement that can be evenly applied. The impacts, Vic kind of started to talk about retail hospitality, really kind of taking it in the teeth. Different challenges in multifamily, for example, where, nobody's going to the office, or very few people are going to the mall, and everyone's in the building. So there's an operational intensity and focus that you have to deliver when everyone stays at home. Single family, like there's also a slowdown in, there's projects and things that happen in these buildings. Nobody wants you doing a construction project on your building when everyone's, basically not leaving their apartment. So I think varied ramifications, and therefore, like, the opportunities to invest are proportional to your confidence in like how interesting or attractive that startup will be going down the road. So, we have investments in companies that provide virtual touring. Their sales cycle is, completely off the hook. We have investments in companies that help manage employee communications for, tenants in office buildings. They're experiencing accelerated sales. So there are pockets of opportunity in this, despite a sort of broad-based slowdown in the economy in general.
Right, so it's everybody's experiencing it in a different way. We talked earlier about the difference between how you're interacting with LPs versus portfolio firms versus new startups. No doubt those conversations are different. Do one of you want to jump in and share? Maybe let's talk about the LPs. What are the what frame of mind are the LPs in about investing and their traditional real estate holdings, and how that may be influencing their decisions? Thoughts on
Sure.
that? You all got them.
Yeah, I can talk a bit about high level views from our base, without sort of getting into any specifics about a particular LP. I think, look, we count financial and real estate investors as our two major LP groups. I think financial investors continue to be interested in opportunities in the market. A number of them have obviously made money through previous cycles. One thing that's interesting, and it's actually a comment that Sam Zell made about a week ago in Bloomberg, which was, he's like, a lot of the deals aren't pricing where buyers and sellers are clearing prices. So you have sellers who remember prices from 8 weeks ago, and are, remember another asset that traded at a particular valuation, or remember their friend sold an asset at a particular valuation, and they don't want to feel like they got, they missed the prime opportunity to sell. And then buyers who are expecting a discount. So to some degree, the amount of what you call like really qualified opportunities at exciting prices has, at least in our view, been pretty muted. There was a wave of businesses that needed funding, some of which you didn't want, and some of which, were experiencing business level distress associated with the price. And then other entrepreneurs who were just waiting, which is what our financial investors acknowledged. So they were like, continued to be interested in investing, but still waiting for opportunities to hit that clearing price. On the real estate side, not to repeat myself, but I think, again, the retail, hospitality, and office owners are really dealing with first making sure that they can keep their core business operations intact and sort of moving towards a solution. And that also means in some respects slowing down certain tech investments, not on a permanent basis, but just in terms of a priority order basis, whereas other assets have sort of, like I said, seen a tailwind. So it's very stratified. Financial investors want to see interesting opportunities. There are interesting opportunities emerging. I don't think there's a glut of them yet. And real estate investors continue to be stratified across the underlying impacts of COVID to their business from a perspective of their near-term investments in major technologies. And also, by the way, usually when you invest in a technology, you have to then retrofit your business or implement it into your business. So it's not just like real estate investors push a button, invest, and then their whole entire operation then leverages the technology. There's real human capital efforts that go into it. Lou's laughing because a lot of his prior life at EQR was spent with me working on some of these integration projects of technology, and he knows it firsthand. So I think the view is real estate asset owners and managers want to invest. They just have to also prioritize their business right now.
So
I do think I just want to kind of. Oh, sorry.
Louis? No, go ahead, Louis.
Well, I was just going to tag on to what Vic said, and I remember Sam Zell saying the exact same thing about kind of bid-ask spreads during the Great Recession. We had a ton of capital. We were super excited to deploy it, and you couldn't get even to really price discovery. People thought their assets were what they were worth before. Everyone who wanted to buy at some sort of rough public market discount, and not a lot of things traded in 2009 in the real estate world because of that. And the same thing is happening very much in our little corner of the world as well. And also I wanted to echo very much the owner operators response to COVID-19 is very different from the financial investors response. The financial investors that we've spoken with have said, wow, this is like wind in your sails, gas on the fire, this is going to drive adoption. And I think, the initial response from operators was like, hey, we got to deal with this. But, in the sort of 6 weeks or so that we've been through already, I would say a number of LPs have expressed to us that the interest in adoption and deployment of technology has never been higher amongst the senior teams. And so, I do believe that this will be, absolutely on balance positive for our sector of the world. Will everyone survive? No. But I do think that more people will pivot and we'll have hardier startups, and this is only going to help fuel that fire.
Yeah, KP Reddy said that notwithstanding the human toll, this is acting as a catalyst to complete the digital transformation of our industry. There's pressure to continue to transform the industry that and fully utilize what's available to us. To this point, though, there's a great question that came in. How do you, when you're speaking with one of your LPs, on the one hand, you present to them these tremendous opportunities, but oh, by the way, your existing holdings are getting hammered. Now, that's not always the case, but do you ever have to kind of do this dance? Any of you?
I mean, sure. So obviously, there are companies that aren't able to sell their products right now, right? Whether it's in businesses, in like the three major categories we've identified as being impacted. And I think I think VC spent the first 2-3 weeks in this going through portfolio company by portfolio company was to be able to take a position of where are we with these businesses and what do we need to make sure they can survive to the other side so that they can get back to business. And I think if you actually look at a parallel of our industry, it's not a perfect parallel, but in the private equity space, you saw major private equity firms on their earnings calls take 15-20% haircuts on their existing portfolio. But the interesting thing that they all comment on is we don't have to sell right now. But there's no, we have the liquidity in these businesses and in dry powder to support businesses through this cycle. So we don't need to sell at distressed pricing. So in fact, why I think that the question's so appropriate is you can see existing businesses that you need to have new financings for to help them survive, even when you have, a new opportunity to invest. And I think there's those opportunities exist, and not being a forced seller is probably one of the huge advantages private capital has over, other parts of the ecosystem where, you have margin limits, et cetera, in certain public equities, and public equity investing. So I think, sure, some existing holdings you're going to need to find opportunistic financing for. If you help them survive to the other side, there's money to be made. You should also take advantage of the opportunities in the market.
Shawn and Julie, you go ahead, because I know you work with a lot of early stage and seeds. So what are you seeing?
Yeah, I would just add, I think the ethos and what we see among many founders is you have to be an optimist, right? You're starting an early stage company from scratch. You're building something from the ground up that didn't exist, and you need a lot of optimism and willpower to get through that. And I would say the same thing about VCs. We're optimists. We come in at a very risky part of the cycle, and we, put capital to work because we believe that these companies can be huge, category-defining, billion-dollar businesses. I think LPs in general, and most of our LPs are, financial institutions, hospital networks, foundation endowments. Some of these folks are really getting crushed during this time. And I think they're definitely more, I would say, circumspect in the way that they approach their financial holdings. And so I think for us, many times we want to deliver to them this vision of optimism. We can get through this. This is going to be such a transformational time in terms of creation of really resilient, sturdy companies that can get on the other side of this thing and be, huge. Whereas with entrepreneurs, when we're chatting with them, a lot of it has to be about, hey, you're doing a great job, you're pulling through. And frankly, we've just been so impressed with our portfolio companies and the resilience that they've shown in trying to weather this all. But a lot of times I think we're trying to tell them from a messaging perspective, plan for it to be worse than you think, because a lot of times people can be pretty optimistic about runway. And if you don't take actions now and cut expenses now, it can certainly bite you on the other side of it. So, it's a little bit about knowing your audience, and you're kind of talking in two different ways. But at the end of the day, I think we still are optimistic people. We are obviously still bullish in the category, which is why we're here and we're talking about being open for business. And I think we all mean it. We want to find really great companies. Someone said that there's never a bad time to start a great company. And I truly believe that.
Julie, can you, just to follow on to that, what metrics are you looking for? Let's start, this would be different for new versus, every stage. This would be different, but what metrics are you looking for? And I'll open it up in a moment to everybody else. Can you share with our attendees some ideas on the kinds of metrics you're looking for, given the circumstances?
Yeah, it's hard to have hard and fast metrics across so many different categories, but I would say for us, what we're really looking for is execution and momentum. And so, when we see a pre-seed or seed startup, in many cases, you may not have a fully fledged or fully built out product. You may not have, a huge customer or user base. But if every time you're talking to us, you're showing momentum and growth and an ability to execute, I think those are the proof points that get us really excited. And so to the point of, are metrics changing? Are we expecting different revenue milestones? Sure, we get that you're being impacted, but if you're able to show solid sales or customer or user growth through this, I think that shows a lot, especially during such a tough time.
Shawn?
Yeah, I would say, we can look at the sort of core metrics of how do we drive down CAC, or how do we make you more operationally efficient? And I think we can be helpful in that. Especially, a lot of us that come from an operating background and sort of we've rolled up our sleeves. I'm sure, like a lot of the other ones that we talked about, triage, we've really gotten involved in what their models look like and how their business activities are going and what their operational procedures are, using our expertise, in the market and going through these and say, these are the things that are going to get you to the other side. And I do think having the companies at least, take a look at some of the things that they couldn't do because they're doing a million things when they started. Now they have some time to readjust and take a look at the processes that are going to help them on the other side of this. And it's really getting prepared to come out of this whenever this ends, and we don't know, but you need to be ready on the other side. And some of these have paused, like Vic said, we have companies that, what was really interesting is a lot of these companies had their best months in March and let go half of their staff. And that's really hard for these companies to do. You said the word panic earlier. I think it's sadness and disappointment to going into your stabs and saying, we just had our best month ever, great job, and now there's this, this crushing, stop, and people have to let go, and these are friends and that help them build their businesses from scratch. So now it's going back, it's doing all the things like everyone else in the world is. What are the things that I can control? How do I control those things? Because I can't control the outside so much anymore. But I can do my processes. I can look at my sales, my sales, go to markets, my pricing, are my models right? And how do I best be prepared on the other side when we start to come out of this?
Yeah, Louis?
I was just going to say, like, we're in a relatively fortunate position in that most of our, all of our core holdings have raised money in the last 12 months. And, there is, when you're working in a startup and the growth rates are high and the sales cycle starts to slow, at least for some people, there is a sort of relief that comes from that. And the ability to actually focus more resources, especially at the founder level, on product development. I mean, there is like an upside to a slowdown for some of these firms, independent of the fact that it creates new business opportunities.
Yeah, there was a comment in one of the earlier sessions that those that are at seed or seed plus, where they were on an 18-month runway to develop product, they've now got the 18-month without a lot of distraction. Assuming they were funded, they've got the 18-month to stay focused and limit their distractions. Although you always want to be planning toward the 18th, toward that 18th month or 12 month. What's your outlook on hiring? This was a specific question from an attendee. Outlook on hiring for those who want to enter or are changing jobs within the broader built environment technology space. Is there still hiring going on?
Sure. I think, across the board, our portfolio companies, even the ones that have conducted layoffs, are hiring for certain roles. I think that, I and the rest of the panelists would agree to the fact that hiring is down meaningfully. I mean, I think that's sort of a pretty clear statistic at the national level. Certain jobs in engineering and product can be a little bit more resilient than sales, because the sales pipeline is slow right now. It's hard for a management team to invest in sales personnel if the pipeline's just slow, right? Like, it's intuitively. But I think finding a great company to work for and being able to articulate why you want to be there to the management team is probably more true now, more so than ever. I'm thinking of a candidate that applied to one of our companies that's still growing and still hiring, and just like that candidate explaining why they wanted to be at the company was actually very impactful, because this is just a tougher job market, and I think everyone acknowledges that. But yeah, I mean, great companies are built through cycles, and the best management teams know they have to hire. Now, unfortunately, some of them have a view right now, which is understandable, that, hey, our sales cycle is very slow. Sales, and there's an interesting statistic on this I was reading about online, which was it's really sales and customer success, unfortunately, which have been hit the two hardest by slowdowns in businesses related to COVID. So I think hiring is still happening. It's definitely slower and harder, and I think that's just going to be the landscape for the coming few months until, I think, as Shawn mentioned, until the health crisis associated with this is put to bed.
Yeah, I think it does depend on markets. Like I think we have, if you're in the mortgage space, they're hiring thousands of people because they can't keep up. Or if you're in some of the services buildings that we have, where they need people to perform those services, and so it really does matter. I think the other thing too that we've talked about, there's a lot of talent coming on the market that unfortunately, for better or for have come from companies that have done layoffs, and these are really good, talented people that are now looking, this is going to force people to say, what do I want to do? And I think startups or even later stage companies can take advantage of that. One, talent is going to be cheaper, right? People are going to be unemployed here, and you can probably get someone that you didn't think you could get before, because people get disheartened by that and say, I'm not going to go work with, I want to go try something new, and here's an opportunity for me to do that. So I think we've told a lot of our CEOs that are looking to fill out teams, if you have some capital and you allocate it, you can get some really good folks today.
Julie, can you share with us, the Urban Innovation Fund is in some other really interesting areas, CivTech, GovTech, a little bit of food. Can you share with us what you're seeing in some of those areas that might be instructive to this conversation, which has mostly been around kind of fintech, real estate tech, construction tech?
Yeah, I mean, I think like most everyone else, we have a portfolio that is both facing tailwinds as a result of, COVID, where, we have a lot of investments in the future of work, and certainly that's being accelerated quite quickly. I do think that for most companies, though, this is just a time of extreme uncertainty. And so, I don't want to paint too rosy of a picture, because I'm sure all of the CEOs and entrepreneurs on this call are probably worried and scared. And, I certainly share that and empathize with that from a, somebody who supports founders' perspective. I think it's been a really interesting time for what I would call the smart cities sector more broadly. So some of you might have seen that Sidewalk Labs pulled out of the Toronto project, announced yesterday. It was a little bit of burying the lead, because they also announced an infrastructure fund, but it's clear that there is some retrenchment going on. What I would say from that perspective is, kind of twofold, and two lessons that I would impart to founders who might be working in, smart cities or providing technology that could be, sold to smart cities. The first is just, regulatory challenges exist when you're selling in this space. And I think Sidewalk Labs and Google found that out firsthand. And, we oftentimes talk about regulatory challenges when big companies are, kind of in the press about it. So Airbnb, Uber, Lyft having, big fights. But I think that what we've seen is you face that, especially if you're working in a regulated space early on. And a lot of early stage startups don't necessarily have the capital and means to hire a big lobbying team. And so I think being smart about that from the get-go, and really surrounding yourself with advisors and other folks that can be helpful to you as you grow and scale and face this regulatory and political pushback is important. And the second thing is, we are still long-term bullish on this space. And so again, showcasing that you're solving a real need, showing that, you can sell through this turbulent sales cycle, I think that only showcases the fact that you're a need to have as opposed to a nice to have product for many people. And as long as you can show that and execute, I think you will go far, both from, hopefully earning revenue, but also, from a fundraising perspective, if that's what you choose to do.
Thank you, Julie. While we're on the topic of different categories, you mentioned earlier that some of our most iconic companies have come out of tough times, which is true if we went back and looked. Let's talk about what the future might look like. What opportunities are you seeing and encouraging, assuming that you realize launching a new startup right now is challenging, so you better have a really compelling story. So what are you seeing that's compelling? What are you guys looking for and looking at?
Sure. I think on our side, we continue. Look, I think shifting your entire investing strategy because of a health pandemic is not the best of ideas. So I think most investors are trying to be thoughtful around what adjustments need to be made as it relates to businesses that are going to have near-term sales headwinds and how to fund those businesses. But like broadly speaking, I think most investors, especially I think given LP mandates, want to be focused and want to maintain consistency of strategy. It really doesn't make a ton of sense to be pivoting your entire ship because of something that was not just unpredictable, but also to some degree will have finite length, at least from an economic impact standpoint. It's just TBD how long the length of the economic crisis because of COVID shutdown lasts. So I think from our side, we continue to be very active and looking at opportunities. Our fund focuses, our second fund focuses very much at the Series B stage of software and marketplace businesses. Obviously, those companies in the digital close space are particularly interesting right now. We had a set of existing investments in what I call digital close of sort of call it residential real estate transactions. That businesses and those business lines have seen accelerated tailwinds because of the need to work from home. And now it's not just a nice to have, as Lou mentioned, it's a need to have. You have to be in a place where you can close transactions digitally. But I think for us, we continue to be disciplined and try to be disciplined investors focused on our core mandate, which, you know, I think we've been centering around the Series B stage for software and marketplace businesses, and making adjustments at the edge, which is to say, if you're in an environment of prolonged economic inactivity, you know, you need to be thoughtful about what that means from a sales underwriting case, but trying to keep the strategy very set on how we initially articulated it to, you know, our limited partners.
That follows with Michael Beckerman, one of his recent blog posts. He bulleted some of these. One was anything that is digital, frictionless, or involves less manual intervention. So I think, Vic, to your point, he also said back to work solutions. We're seeing a whole bundle of what we might now categorize as, you know, kind of this sub bucket of back to work solutions. Then AR, VR, digital twin, construction tech, which we haven't talked necessarily about construction tech, maybe we should. And then also some consolidation of existing startups where the point solutions will accelerate. And maybe we'll come back to that topic because that's a separate discussion. But Louis, what categories do you think are interesting?
We're actually invested in all those categories. And so, you know, certainly count ourselves fortunate from that perspective. I guess I would just mention on the last item, as far as construction tech, and then also I might mention on consolidation. You know, one of the things that's been a drag on new development projects has been the cost of labor. And, you know, this is certainly going to change the cost and availability of labor for construction in a positive way in terms of underwriting. And one of the other things that I think a lot of people in you know, the real estate community are trying to figure out is there's also going to have to be some adaptation, like physical adaptation, renovation of spaces. And that's another area where, you know, construction tech has come a long way, but there's also still substantial opportunity. And then on the consolidation piece, you know, one of the things that keeps us from investing in certain startups is we have a conversation about it and we say, you know, is this a feature? Is this a product? Is this a company? Or is this like a platform? You know, kind of the scale and scope. And one of the things that happens is you have a lot of these kind of little companies that do little niche things and they don't get any distribution efficiency. Like it hampers the economics. And so consolidation in some ways is good for the real estate industry in that, you know, long-term winners are going to be pulled together from some of the different players, and you know, winners will emerge. And I think it's on balance very productive.
Yeah, I'd like to add to that. I think I agree with Vic wholeheartedly. You don't change your strategy. You know, here today, we've gone out and raised money based on a strategy, and I think there's some modifications there. From the consolidation point of view, we welcome that. It sort of happened in real estate in 2008, and it, you know, it does help sort of thin the herd a little bit and get the companies and the people that really should be in the space when that's there. One of the things that we've looked at is how do we take our portfolio companies to market together in a broader solution than they can do on their own. And that is not a financial consolidation, but we have the ability to sort of take the co-opetition out and even work with companies in other portfolios to say to our LPs, let's not go after, you know, we have some niche solutions here that are solving problems for you, but why don't we sort of group these things together, and whether that's integration or whether that's pricing or whether that's go to market, implementation's hard. And that's what you guys are always, you know, fight against. Oh, here's another pilot for another something that we're going to do. And now my resources are limited, so I can't do that. But if you can take your portfolio companies and sort of stitch them together along the transaction workflow or experience or something like that, that's where we've seen a lot of adoption. And that's consolidation through our own means without actually, you know, financial consolidation. And maybe at the end of the day, that does happen. But it's helpful to our companies to go to market together for distribution. It's helpful from the LP side because they only have to do one implementation of a sort of pre-curated product set that solves a broader challenge than just the niche.
You know, my colleagues here in the Real Estate Innovation Lab were struck by how that hadn't happened. We're 8 or 9 years into the cycle, and I think it's because there's been so much capital. There hasn't been the pressure to start getting together. Would you agree with that? And do you think now this is the defining moment that's going to push in that direction?
Yeah, I mean, you have to. As we do the triage, part of our job is to be very honest with who's going to make it and who's potentially not. We've got capital allocations. We've set aside money in reserves to, and that some of that stuff may change, and we'd be foolish to think everyone's going to be the winner. We have to make some decisions, along with our other investors and boards, and find who we're going to double down on and who we're not. And so part of that is, can we consolidate some of that even in the portfolio, and can we consolidate that outside? So, I do think we drive a lot of that, especially from sort of our, sort of core investments where we have a lot of influence over, but for sure I see that happening as well.
Thanks for that. Any other comments on that concept of convergence? I think we had a lot of good conversation on that. Let me just shift gears a little bit. We haven't talked about what's happening outside the U.S. We haven't intentionally talked about inside the U.S. But can we talk a little bit about what's happening in some of the other markets, Europe, UK, maybe Latin America? I don't recall who's got holdings outside of the U.S., but those of you who do, if you could maybe give us a perspective on that as well.
Yeah. So
if it's different at all,
we have certain holdings outside of the United States, primarily in some in South America, some in Europe, and I would say it's in part very similar to the experience that we've seen in the U.S. Certain of those countries don't have as powerful federal reserves as the U.S. does, so you've seen differing impacts to their economies. We give the Fed a lot of credit for really stabilizing the U.S. economy to the best extent it could. I think we continue to expect pain to come, but when you're the world's reserve currency and can issue bonds, at least right now, in nearly unlimited quantities, it just gives you more flexibility, which definitely trickles down to the rest of the economy, and sort of at least keeps certain things more stable. In other countries, I think specifically South America, there's just a less active involvement by the government, specifically the treasuries, in the day-to-day businesses. So there you've seen even more bifurcation. Companies that were well capitalized, that had reserves, even if they have some business disruption, have just huge opportunities to purchase and do interesting M&A because everyone else is sort of going out of business. There's no paycheck protection program for a few months, et cetera. They're just going to run out of money. And then businesses that are less well capitalized are, as I mentioned, under significant stress. So in certain of our holdings, fortunately, they were more later stage as businesses. So they've actually seen certain opportunities arise because the market has seen a lot of corrections that haven't been normalized by the local country's Federal Reserve System. But those holdings still in aggregate are not a major part of our overall portfolio on a percentage basis. So I think we're spending an appropriate amount of time on them relative to the percentage of portfolio that they represent. So.
And have any of you heard from your non-US, either LPs or other investment sources, capital sources, have you heard any different perspective from them than what we're hearing here?
I mean,
I'd say a couple of things.
Yeah, go ahead, Lou.
Go ahead. No, please.
Well, I was just going to say, I think from our LPs that have global real estate holdings, I think it's been really insightful for them, because if they're in China, if they're in Germany, if they're in these other places, they can give us insight as to, so that they can be the canary in the coal mine to see what's happening there, because we are weeks or months behind depending on where you are in the world, right? And so we're sort of using that insight so we can figure out some of the things that may be happening here, help inform our companies, and and then taking some of the companies that are US based that may be able to help in those international markets. So we look at it from a little bit different way. It's more of an intelligence and a view into the future, weeks or months ahead than anything else. So it's been really interesting to get that feedback.
Louis?
Yeah, I was going to share that, very clearly, like Asia is ahead of us. And like there's been sort of renewed interest and demand in, both us as a venture firm, as well as for some of our portfolio companies that are now going international. The other thing I would say is, COVID is a global phenomenon. And so it's kind of a unique situation in that the whole world is really, maybe a mild exaggeration, but internationally, this is a big problem and an issue. And so, people looking to the U.S., which has a fairly, on the relative spectrum, a fairly mature real estate tech marketplace, and people are looking to firms here to figure out if they can apply the technology. So it's like the global piece is interesting. I agree with Shawn. Like people are at various stages of whatever we're calling this thing, like re-entry, restart. Nobody knows, but it definitely is. Just like countries are taking different approaches to COVID. Like some people are taking different approaches to deployment of technology.
Yeah, and I'll share, one thing that I got that was actually a bit of a concern that I think is, worth our country and our leaders thinking through. So we count a number of institutional limited partners from Singapore. And actually, as you've seen more publicly and, we were hearing privately weeks before, Singapore's actually had to shut down again, in part because of what started off as like localized spread of COVID in sort of areas where they house domestic workers and other migrant workers. And what's, I think, a little concerning about that is like their contact tracing and government efforts to track and manage COVID are an order of magnitude better than those Western countries. I mean, that's pretty clear just from a use of technology standpoint, a early activation of contingency planning standpoint. Singapore was amongst the most thoughtful in their approach, and even they've had to shut down again at least significant parts of their go-to-work economy. And so one of the things I remain optimistic about in the long term, but cautious about in the near term, is how our country and others in the Western world will manage both the going back to work process and then how additional flare-ups will be handled. Because if you have to keep shutting down, there's like real lasting damage you can do. So we commend, for example, California Governor Newsom, who I think was one of the first governors to shut down the state, and at least on a numbers count basis per capita, there seems to be positive signs from having done that. Obviously, despite the toll that the meaningful human toll that California took, but it's definitely one of the concerns, and it came straight from our limited partners in Asia. We're like, hey, we're not out of this yet, so be optimistic in the long term. But we at least at our country aren't out of it yet. And I think Singapore has had trouble managing contact tracing and stemming this. I think it's likely other Western world countries sadly will too, because of a lack of technology sophistication utilized by government. So
more broadly, there was a really interesting, really good article in TechCrunch a week or so ago discussing Latin America, and that they have taken advantage of being a little later to the party by observing what's going on here and learning from what happens in the US market so that they can sort of leapfrog. This was more broadly technology, but certainly our experience with the real estate tech category in Latin America, same thing, being able to leapfrog and run up the innovation curve. So Julie, this was a question from the audience. You mentioned that there was going to be a lot of dry powder that there is as a result of COVID, but some question about, is it an oversupply? Will there be enough deals to absorb given the mandates to deploy? Do you want to just comment on that?
Yeah, sure. I mean, I would say the record dry powder is also kind of coming up against a question of timing, which is, what is the timeline for deployment of that dry powder? And so the question I think now is, I feel like people have been more focused on triaging their portfolio and, between making sure your companies can weather the storm and, the stimulus act with PPP and paycheck protection, we were spending just an inordinate amount of time dealing with that. And now as people are kind of getting back into the swing of things, will deal activity kind of continue at the clip it had been? Unlikely, but I think that there will be bright spots, and especially as people transition and start getting comfortable with the idea of doing deals entirely via Zoom. I do think that will probably be more advantageous for startups at the pre-seed and seed, where investors might be a little bit more comfortable kind of getting used to that. I think it might be harder to imagine, a Series B funder putting down a $20 or $30 million slug, but correct me if I'm wrong, Vic, because hopefully, our intention is obviously to help our companies at that stage as well. So I think part of it is, there is capital that's out there. It's just going to be a question of, will it be deployed over the next 1 to 2 years, or will VCs take their time and kind of use more of their investment period because they have it and they're trying to wait out and see what's going to happen in the broader economy?
Yeah, I always like to say dry powder is dry until it isn't, and it's in part a tongue-in-cheek joke, but I think, look, in venture you rely on consortiums of investors. You're typically not seeing an investor own obviously a majority of a business. There are rounds that come together where you have a lead investor, you have follow-on investors, and the risk aperture has just fundamentally changed, right? Like there's a risk aperture that didn't exist 6 months ago that we now have to contend with. There are real differences if this lasts for 1 more month versus 1 more year. And I think you can continue looking at projections and try to make your best guess as to where those projections indicate the likely outcome will be. But when risk aperture increases, pricing is impacted because you just have to take into account the incremental risks, and that impacts pricing, right? Because of how you think about underwriting, discount rates, et cetera. So when the risk aperture, which I believe it has changed, you just have to take that into account with your underwriting. And I think that's why you're also seeing slower velocity of new deals being done. And part of it is just a fundamental reset of venture markets, where for a decade you've had on at least a relative basis, easy access to venture capital. It's never easy to raise money, never easy to start a company. But when you just compare it over the last decade, excluding, sort of now in 2020, from 2012 to 2019, access to venture markets had never been higher, both in terms of quantums of capital raised, number of funds investing. So that has definitely changed. And I think it'll be very interesting to see what happens over the next 6 months, because it'll be very telling as to what this vintage of venture investments look like.
Yeah, I think there's been a lot of money raised in 20s. All of us probably raised through that time. So we have longer horizons on 10-year funds and things like that. So there's no rush today for a lot of people. The other things that people need to understand is that valuations, it's sort of, I don't think people have come to the reality yet. Sort of, I see it in the housing market, right? People, like you said, you see it in construction, and you have to look at public equities. We have to go off public comps, and if there's inactivity there, and lower valuations there, that affects the private markets. And so I don't think that's fully trickled through yet, and people need to start to come to grips with that. But that's just going to take some time for people. Like Vic said, we really are 6 weeks into this, and everyone's been so heads down in those 6 weeks triaging and doing all these things that we're finally starting to come up for a little bit of air. But I don't think a lot of the financial realities have started to hit yet, and those we'll probably see more in the next six weeks are coming. So this will look different when we have this call in another 6 weeks. Things are going to be different. So that's what we see.
And you also have to remember that the aperture of the impact is not just increased from a risk standpoint, but also a category standpoint. And what I mean by that was, in 2008, 2009, businesses in San Francisco and Silicon Valley and tech globally actually did okay to well, primarily because there was a real systemic shock in the banking system, and that was catalyzing additional shocks in the mortgage market. But you saw businesses build through that and still see increasing revenues. But if you're in the market today and you're in advertising, you're in software sales, you're really seeing impacts to your business. So you have to be careful about saying, there's easy parallels to 2008 and previous cycles. I think there's similar parallels from a shock standpoint, but we've never, in at least these last vintages of venture cycle investing, seen the impacts of a virus shutting down an economy that hasn't been shut down since it started functionally at scale. So I think that's also one thing investors are cautious about, because even companies that are in certain otherwise attractive industries, if you have to sell advertising and people aren't buying products in logistics, e-commerce, and other interesting categories, but you need to sell a product and there's no underlying buyer there, it's not just like, oh, the banking system has issues, mortgage market has issues, but social media can do well. There's real sort of risk across all major subgroups of types of commerce in tech and non-tech that you have to take into account now.
Right. Thanks for that, Vic. I'm going to turn it back over to Ash, because Ash, you had a poll that you did, I think.
Absolutely, Steve, and our entire crew today, guys. Thank you very, very much. Very insightful. So at the top of the hour, we asked what will be the most impactful tech in 2020. We asked you, our amazing audience, to chime in on this one. And for the third week in a row, health and wellness wins out again at 42%. I paused there for comment from our panelists, including you, Steve. I'd love to kind of get your thoughts on health and wellness, and followed by tenant engagement at 31%. Pause there for comment from our panel today.
Yeah, let's hear from the panel on that one.
Yeah, I mean, there's two things that we've seen that. I mean, we've got a couple of things. We have a company that used to do outside maintenance. It's now inside maintenance, and I do think a little bit of health and wellness. You need to figure out what that is, and sort of, is air, water, is that air, is it water, is it light, is it fitness? Like, that's a really broad category that encompasses a whole bunch of different things. So, there are different, you can put some of the health and wellness into tenant engagement and, companies that are doing that. But, I do think there hasn't sort of been some standards set yet. We're gonna have to break down what health and wellness actually is and who that's for, and so I'm interested to sort of hear from the other folks what they think that is. We've looked at the lighting, microbial lighting and what that does, and we've looked at fitness and all of those, and we have those in the portfolio. So I do think, I do agree. I think we have to be a little bit more granular as to sort of what that means for who, and so I'd love to get everybody else's take on sort of what they're seeing in that area.
Yeah, I'm in the same position as Shawn. I feel like it's very hard for me to understand.
I know, right?
Both here in Chicago.
Yeah.
It's very hard for me to understand both, like, what the particular manifestation of health and wellness being voted number one is. It's very easy for me to understand why everyone would check that box, because we're all like trapped at home trying to like not kill people by mingling in society as humans are wont to do. I do, like, it makes me a little bit nervous in the sense that I worry that like some of the solutions and things that people will spend a lot of time and effort focusing on may not actually be an effective response to another COVID type outbreak or something similar. And so it's like, can't disagree with the answer. Very difficult to invest against right now. Like, I haven't seen anyone with the like, oh, put this sensor on the wall and it will identify and kill COVID in your building. And I don't expect to see that one anytime soon either. But I do think that the kind of communications with maybe semantic, but occupants of the building, not just tenants per se, is increasingly being highlighted, as basically everyone knows that, kind of to Vic's point earlier of like, there could be like an uneven return to work requiring like retreat as well. Any technologies that help companies manage through those situations more effectively, like bridging the physical digital divide, even if they're just simple communication tools, are gonna be really advantaged. And that's an area where I would feel a lot more comfortable investing, and am investing today.
So Louis, I want to know
Yeah,
how much Shawn is paying you in Portillo's credit cards. Okay.
He told me he wanted Lou Malnati.
Yeah. Well, I'm an East Coast guy that's in Chicago, so you know what? A pizza is not the thing where I'll go to Portillo's. But you know, Lou, anytime that you want, we'll meet you there. So
As soon as the governor lets us out, I'm happy to buy you Portillo's.
I can add a little color. I can add a little color to the wellness or the well-being conversation. This existed prior to COVID, and it's a coincidence that now it's on the forefront. The center's early work on LEED buildings and green buildings, when that first hit the industry, we didn't have any data to measure, so we didn't know if all of this was gratuitous. We didn't know if it was going to return value. We now know with the research, not only at MIT, but the research that shows that green and sustainable buildings trade in the capital markets at a premium, and also they lease at a premium. So I think what we think will happen is that down the road, we'll be able to look back at this wellness conversation, however it manifests itself, because that's unclear right now. But we'll then be able to evaluate, did it help productivity? Did it yield do these buildings perform better in the capital markets? Do they perform better in the space markets? We'll be able to have a better sense, but it's very early, the same way LEED and sustainable buildings were 15 plus years ago.
Steve, I mean,
I think the only thing I'd add to that is, you know, if you saw the New York City subways for basically the first time in history have been shut down to be disinfected and cleaned. So they're probably the cleanest they've been since the inception of the MTA. And the idea that folks aren't going to expect similar qualities of cleanliness and disinfecting in their workplace, I think is unrealistic, right? I mean, and I think I agree with Lou's point. It's a tough place to invest against as a venture investor, because cleaning services aren't really appropriate for venture capital. So part of it's like, there's going to be definitely enhanced cleaning services in office buildings. I think that's clear. In multifamily, that's clear. But the primary form of venture investment against that's probably going to be in like building level technology and tenant engagement than it is going to be in a direct solution. I agree. I don't know if I see a near term like hardware solution that's going to be investable, that's going to say, hey, we detect and kill COVID. But I think you're going to have to, office owners and managers are going to bear the costs of increased cleanings that, workers and employers are going to expect, and then consumers are going to expect in their multifamily buildings, especially when they see government agencies cleaning, government-owned assets. The expectation is going to be similarly high.
Julie, how do you see that at the city level, or at the outside of the four walls, or in the context of the city and the urban environment?
I think cities have notoriously, and governments more broadly, have been notoriously reactive. They're not normally the ones that are, driving the tech innovation. But certainly, since there's so much more focus on it now, there's no way that we can function as a society when people are afraid to get on public transit, for example. So, I definitely see a need for cities to, react to this crisis. But I think a lot of those solutions will probably be pushed, either from the private sector into public, or will at least require a level of coordination that I think most governments are frankly not very used to.
Yeah, I think, I talked to the company that manages the Willis Tower, right? 100 elevators, 100 floors, they're more worried, how do you, it's 15 minutes to get to 90th floor now, and how do you, do that? I would say the bigger thing I think big commercial owners are looking at is, how do I get people to work? In public transportation, as Julie was saying, like, that's the bigger issue. There are two sides to this. I think usually what happens here is the pendulum swings way too far, way too fast, right? And so I think you're going to say, it's like everyone's temperature screening, everyone can't get in, like that's, and I think some owners are pushing back now and saying, I'm going to put some hand sanitizer downstairs and you guys are kind of on your own, because I don't want to take the liability for all the things that, and like where on the spectrum do I go? And because we don't know the liability opening up here. And if I provide a bunch of different things for you and something still happens, am I liable for that? Versus,
right.
This is my building. You're more than welcome to be in my building. This is the protections that I'm going to give, and they may be minimal, versus some that are going to have MERV 13 filters, and they're going to have, and they're going to clean 4 times a day, and they're going to, have microbial, they're going to have all of these things. And sort of people are going to have to decide where along the spectrum they are. But I think companies need to realize that is this a long-term thing, or is this something short-term where people just need to feel better in the short term to get there? And so around the investment thesis, I wrap that in. We've got to decide as long-term investors, is this something very short-term that we're just going to see a bump now, or is this a sustainable business as a Series A or seed investor that's going to return in 5 to 7 years? And if there's a vaccine in 6 months, and I'm just making up numbers, but that's I think the thing, as Vic said, not all of these are venture investments, and we've got to listen to our LPs, to what they're going to do, translate that back into what is their business needs and what are companies that they're going to actually purchase products and services from, and make our investment thesis off of that.
So I know we're a few minutes over, and Shawn, thank you for that. I know we're a few minutes over. No, it's fine. Absolutely fine. This is great content. A few more questions came in, and then we're going to wrap up. A question came in. I'm going to bulk all this together to kind of save time. A few questions came in, and one question came in from Mike Beckerman. We all love Mike Beckerman. What's the climate for? Hey, Mike. What's the climate for VC raising new rounds for their funds? That's one. And the second, barring any conversation regarding portfolio theory and dead cat bounces and all that, all the stock market and investment strategies. A great piece was written yesterday in the New York Times, how investments in the stock market has risen with the tech index up for 2020. And they mentioned, obviously, the culprits, obviously the big names that we know in tech, big tech now. If the public markets are any indication of how the private markets are going to react, what's your take on that? Just generally speaking, we see that the investments in the stock market have actually increased. We're seeing, and the question that we've seen now is is basically price compression. Are we seeing the same thing also in venture capital?
Sure, I can give a quick minute of commentary and let the rest of the folks, offer their color. I think at the firm and fundraising level, I believe the question is really around venture funds raising funds for sort of the firms. It's obviously helpful to have a track record with limited partners who know you and you speak to often, in part because of times like this, which are obviously unprecedented, but it's helpful when you have a trusted relationship because you're able to talk about capital deployment opportunities over Zoom, and you have a long-standing relationship that existed prior to that. So I think we've seen continued interest from limited partners in opportunities and even stuff on an opportunistic basis. I would probably agree that raising a first-time fund de novo right now would be difficult because people would want to meet you in person, and you can't do that in most places. I think you don't want to be thoughtful about commentary on public markets. I'm not a public market investor. It's not what I do day to day. I think being one thing that we've seen is, and this is sort of intuitive, there's been a big stratification in the public markets. If you look at real estate indexes or underlying real estate companies, a number of them are down over 50% year to date. But obviously the index specifically, S&P 500, there's other companies that are representative of the index, including technology names, many of which are benefiting from capital that's flowing into the markets from a view that there really isn't anywhere else to put your money when interest rates are at zero and the federal government's printing money via the issuance of bonds. So, I think we don't try to comment too much on public markets. It's not what we do at Fifth Wall, but I think broadly speaking, we are seeing a significant amount of stratification in public markets as well. You can see a number of really iconic real estate names trading down over 50% year to date. And if those businesses are the underlying customers of some of these technology companies in real estate, intuitively those technology businesses in real estate are impacted if the underlying customers are impacted. So I think that's just a high level view, but there's a lot of specification needed, and you have to evaluate opportunities one at a time.
Great. Louis?
Yeah, I would just add on to that. I think, and I'm not sure if Vic was turning right or left on this, but when you do have pressure on public companies, whether they're large real estate organizations or they're incumbent technology providers to the real estate industry, it puts a lot of stress on the organization, and it becomes very difficult for them to focus on new product innovation. Often it's much easier to start with a blank sheet of paper than it is to adapt an existing product. And so, it's certainly not the complete answer to the question, but it does, there are some benefits to small startups that are privately funded in terms of like relative competition from sort of customers doing it themselves or large organizations being as nimble as they can be. So there is some upside there.
I think from a fundraising perspective, what's interesting is typically, when venture is good and markets go up, you get a lot of corporate venture that comes in and sort of off balance sheet that muddies the water a little bit. And then as you have this downturn, you see the pullback. And I think it makes funds like all of ours more valuable to our LPs who say, I don't have the time and resources to do my own diligence, to look at all these things that are coming across our desk. Let me leverage my partners and the people that I put money into. That's what they do, what they're really good at. And let them sort of weed through all the stuff, bring the companies that they're really excited about to us. And those are the ones that we'll concentrate on because resources are tight inside from an innovation perspective. We do want to innovate. Innovation's not dead, but weed through all the BS so I don't have to, right? And I gave you money because this is what you're good at. And so find me the good stuff. Here are my business challenges. Bring it to my front door, and I will get these through. But they'll just be less. You won't be 10 implementations a year. It'll be 5, but it'll be 5 really quality ones that are embedded by partners like ourselves. So I think it makes us, I'm sure we've all seen that it makes us even more valuable to the space.
Yeah, and Julie, love to end it with you.
Yeah, I mean, again, we're optimists. We think that this is a great time to be investing, putting out dry powder, but at the same time, we want to recognize, I hate to say the term because everybody's been using it, but it is an unprecedented time. We don't know when it will be over. And, again, I think it's for startups a time to survive, show that you can have the fortitude and resilience to weather the storm, thrive, see if you can get aggressive, be on the offense, build business, show pathway to profitability. And then, if you can get on the other side of it, I think you can be in a position to be one of those iconic companies, the, Airbnbs, Stripes, Squares, all of these iconic names that were built during the last downturn. And I believe firmly that those opportunities will come. I think we're all optimistic around where we'll see it. Certainly, I think some business models will have a harder time raising during this time. And I saw one of the questions kind of came up around, capital intensive business models. I think they were starting to get a little dicier, especially when the WeWork IPO failed. And, now that capital is being more constrained, I do think it will be harder for those types of companies to raise. But again, if you can get through, show value, one of the great times to be fundraising is when you don't need to raise, when you have revenue, when you can show unit economics that work. So I think, the return to basics, showing sensibility, showing a pathway to execute, all of those fundamentals will put you in a really great position. And we're definitely optimistic and bullish on supporting those founders, especially in spaces in the urban innovation space. So real estate tech, I think will still be a very vibrant area moving forward.
That's actually very beautifully and brilliantly put, and love to end on that note right there, that optimistic note. I know we are about 20 minutes over, so I want to thank everyone for joining today's conversation. Julie, Vic, Louis, Shawn, and of course, Steve, the amazing Steve Weikal. Thank you all for sharing your thought leadership. I hope everyone, our entire community and our amazing audience had a great time. I certainly did. If you have any questions about CREtech or would like to learn more about innovation in the built world, venture capital trends, and of course would like to host your own webinar and promote your own webinar on the CREtech platform, please reach out at research@cretech.com. Again, my name is Ash Gonzandi, and it's a pleasure to be your host today. Thank you to our amazing audience and our amazing panel. Thank you guys very much.
Yes, be well, everyone. Yep, thank you.
Thanks for having me.
Thank you all.
Bye.